Eddie, thanks a lot for taking the time today. Wanted to start with sort of a general market question. The Nikkei in Japan is at a 3-decade low. Nobody thought that was possible 3 decades ago. What are the odds that the U.S. could see a similar slump over that sustained period of time?
I would say it's very, very remote. Even though the U.S. market has had, I would say we've already had our lost decade from March 2000 to March 2009, almost exactly 9 years. The problems Japan faced were much more severe than what we had. Their markets in the late 80s were terribly rigged. I remember Peter Lynch, legendary fund manager at Fidelity Magellan, he said he was at a business meeting in Japan and he was looking over some financial statements, and he said, there's this one figure, I can't figure out what it is, can somebody explain it to me? And they said, oh, it's very simple, that's the share price 1 year from now. So that's how controlled the markets were in Japan. And all of this fell apart, and then they have their version of capitalism, their industrial policy, and the government involved in the stock market. Then they had their zombie banks, which really they were just keeping alive, and they weren't really growing at all, but just pumping money in to keep. And then the real problem that Japan has is demographics. Japan is a very, very old country. It's really almost off the table as far as looking at the statistics. 1 out of 4 people in Japan are over the age of 65. In the United States, which is a country that's getting older, our rate is half that. And this is even as some baby boomers have started to retire. And the problem when you have that is what's key to a country is what they call the dependency ratio. And that's how many people are working or how many people aren't working versus how many people are working. That every person who isn't working, if they're out of a job or even if they're retired, every single day they need to be housed, clothed, and fed. And that's all relied on the people who are working. And in Japan, that balance is really, really getting out of whack. And they just have a nation of retirees, and the fertility rate is plunging. There was one story came out, there was an island in Japan, has about 20,000 people, and their single OBGYN left. No longer works there. And now the whole island doesn't have one because there are so few births. If somebody does need attention from a doctor, they will helicopter them in. This is an island of 20,000 people. Wow. And that's how acute the age is. So America is a very, very dynamic society. We even the problems we have, we're always able to overcome in a much more resilient way. So even if we look at what we've gone through lately, which certainly hasn't been good, it's one of the worst markets in 70 years, basically ballpark the S&P 500 is going to earn about $105, $107, give or take, per share for this year. We don't know exactly, it's still June, but it'll be in that ballpark. Going back to the peak earnings year was 2006. And we made, I think it was about $87 per share. So 87 to 106, 105, that's about 20% in 6 years. That's not great growth, but we are growing. Mm-hmm. And that is what America is, our system does work, as frustrating and as upsetting as it can be. Companies are out there every day and they're making profits and the economy is growing. Certainly not what we'd like, but the idea of a 3-decade slump, I think is the odds are extremely low.
So you're a long-term optimist about the U.S. Let's shrink that a little bit and look at, say, the next 1 to 3 years. So Goldman's chief equity strategist thinks there's a pretty good potential that the U.S. could enter a bear market. What is your view of the shorter term period and whether we can hit bear territory?
It's interesting because I don't remember Goldman Sachs telling me about the last bear market. I think they were pretty sure we weren't going to get that. Well, I'll give you the easy answer. I have no idea. And this is a good thing for individual investors, and this is the message to them: is good news. You don't have to get that right. You don't need to know if we're going to go into recession. You don't have to know what the Fed's going to do. You don't have to know who's going to win the election. I've good news to bring people. You don't have to know that. And, let me give you the outlook of what we have. I'm always an optimist for America. But right now, the market does face some challenges. And right now, the economy has done a very good job, the corporate economy, of rebounding from the recession. Basically, as I mentioned, corporate profits were, for the S&P 500, would be about 105. This is too far out. Next year, they think it'll be about 118 per share. The index is right about 1,300 today. Well, in 2008, they earned $50. And in 2009, I think it was 56. So we basically doubled in just a few years. That's how much we've rebounded. Companies have done an excellent job of growing their profits, and that's what companies are. They are profit-growing machines. The problem is they've done this by cutting. And for most companies, a principal source of overhead is labor costs. So the bad news is they've cut back on labor costs, and we've seen the jobs market is one of the worst jobs markets we've seen in decades, and it has not recovered with anything like a momentum that we should see. So while these companies have cut their way to profitability, now we've reached the turning point where the thing about increasing your margins, it's a great business strategy, but you can't do it indefinitely. At some point, a company can only cut so much, and they have to grow. And that means they have to get either the existing customers to spend more, or they have to get, ideally, new customers in the door. And that's why the economy has been so tied to the jobs market, and the Wall Street has been paying so much attention to that first Friday of each month when the jobs report comes out. Up till now, the jobs just have not been there. So it really is our futures is tied to the jobs market. We can just sort of grind out, growing at a nominal rates of maybe 2 or 3% a year, and we're not going to be able to. The overall company-wide, economy-wide, the profit margin is about 10%. Historically, it doesn't go much higher than that. So we're really not going to see those improvements. So that's the chief concern for the economy is the jobs market, and that's what our future is tied to. Now, the good news for the stock market, and I think what really is the best news for bulls, is that the stock market runs on competition, and its major competition is bonds, specifically long-term bonds. And that's what the stock market, it's a continuous battle with bonds and always pushing for who has the better deal. Right now, the bond market is, it has soared for 30 years, almost a nonstop bull market. And with, just think of it this way, 10-year Treasury is going today for about 1.6, 1.7%. Now, people don't think of it, but that's trading at 60 times earnings. People don't think about that. So would you buy a company trading the PE of 60 and a growth rate of 0? And it's not even rated AAA. We don't even get that. Now let's take a look at, say, Johnson & Johnson. And this is as blue chip as they get. It doesn't get bluer. Dow component, excellent, very well-run company. They've had a bunch of problems in recent years with some recalls and everything, but that's not going to sing Johnson & Johnson. Right now, the company said, this isn't some analyst, this isn't me saying, this is right from the company, said they're going to earn about between $5.05 and $5.15 per share this year. So that's from the company. The stock is going for about $62, $63. So it's about 12 times earnings, or flip it over, that's a yield of 8%. So think of the 8% versus the 1.7% in the Treasuries. So, well, yeah, okay, the Treasuries are, that's backed by the U.S. government. Is that really worth 600 odd basis points? And I believe J&J is still rated AAA, which Uncle Sam is not. And then on top of that, you get Johnson & Johnson has just paid out For the 50th year in a row, they've raised their dividend. So I think the stock is yielding about, about 3.6, 3.8, right in there. So you're beating anywhere on the yield curve.
Yep.
And so when you look at stocks, it really comes down to the math between the value you can get from companies, and I'm just use Johnson & Johnson as one example. This is not some hidden company we're talking about. This is not some obscure value stock. This is a Dow component. And just look at the distance between that and people who are hiding out in treasury bonds. It's a tremendous opportunity for stocks.
You mentioned the jobs report and how important that has become in the last, even in the last 6 months. It seems like it's now the thing everybody's looking at. How should retail investors look at the jobs report? I mean, if somebody is a long-term oriented retail investor, should they pay attention to that figure?
Not at all. Not at all. And there's several problems with the jobs report. And just because Wall Street pays attention doesn't mean individual. In fact, it will make your life a lot better. Again, you don't have to know this. And even we're speaking today on Wednesday. The markets rallied today, and we've already made back much of what we lost from the upsetting jobs report of just a few days ago. First is, I don't think people realize that the jobs report is done by the government. So that means it's not exactly perfect. The plus or minus on the monthly job report is huge. It's gigantic. We wouldn't accept this from any other survey. It said, oh, we expect to make $1 a share plus or minus $3. And that's almost what it's like. And plus on top of that, they're constantly revising their previous reports.
Yep.
And that happened this last time they revised previous reports. And then they revised the revisions, and the revisions to the revisions later get revised. And then the whole thing.
So in 10 years, we'll know the number.
It's literally longer than that. We've had revisions. We've had about a quarter of a century. They'll revise GDP reports.
Huh.
So nothing is surprising as the past is what they say. So as far as paying attention to the jobs report. Overall, in a macro sense, that's important for how the market's going to go. As far as day-to-day trading, to investors who are serious about planning their retirement and building a long-term portfolio, that's just noise. Just ignore it. I'll give you an example, and this is a fact that all individual investors should understand when they invest in the market. Each day, the S&P 500, its intrinsic value rises by about 1/30th of 1%. It's a tiny, tiny amount. Just 3 basis points is what it's rising, and but the average daily swing on the market is about. I mean, it's come down recently, but historically it's been about 1%. So think about that. Each day, on average, you're swinging 30 times what the market is actually worth, what the actual, intrinsic value is. So the stock market is extremely chaotic in the short term. There is good news about that, is that stocks can be mispriced. And for patient investors, you can get good deals for yourself and wait till the other guy panics. But the downside is you just have to ride out these storms and not get caught up in the daily panics of Wall Street.
You mentioned that stocks relative to bonds look attractively priced on an absolute basis. So the Dow is a PE of 13, the S&P is PE of 14, right around the same. Is on an absolute basis, is the market fairly valued right now, undervalued, overvalued?
But I would never say on an absolute basis, and that's the thing. It's always relative. I mean, there's a price I'd pay for anything if the price is right. And what's remarkable is if you look at the long-term performance of long-term Treasury bonds and the S&P 500 with dividends, throw everything in, over the last about 45 years, it's remarkably similar. Now, don't get me wrong, there have been points of divergence, clearly in the late 90s and then recently, but it really comes back the same. They're very, very similarly performing securities. About the equity premium versus long-term bonds since 1968, it's less than 2%. That's not much at all. So I would always say, I would never say just on an absolute level, it's always relative to something.
Let's talk about gold for a second. So gold has gained popularity almost out of nowhere in the last 3 or 4 years, really since the crash. And people are waiting.
Oh, you haven't been talking to gold bugs, have you?
Well,
let me tell you about the religion of the gold bugs. And the thing, I really do love gold bugs because there are people who just get so wrapped up emotionally in this metal, and it's fun to watch. But gold it's an asset like no other. Gold has been a dream of mankind since the dawn of time. Gold is mentioned in the Bible hundreds of times. Gold never rusts. Do you know that? You can go.
Did not know that.
You can go into King Tut's tomb and you can take the gold out and use it as a filling in your tooth. I mean, you have to clean it off, but it's not rusted. I mean, you can use it. It just might be dirty. Something else. Gold is incredibly soft. If you take 1 ounce of gold, you can stretch it out for 50 miles. There's nothing else like gold.
Yeah.
And this is what I find fascinating. This is how I'll describe gold. Gold is a currency, or I would say more appropriately, it's the anti-currency. Gold is the currency that keeps all the other currencies honest. Now, when you think of a dollar bill that you carry around in your wallet, every dollar bill has an interest rate tied to it. We don't think of that, but that's what a currency is. It's a little walking interest rate. Every currency in the world has that, and that's what makes it valuable to whatever level. Now, with that interest rate, there is sort of a I don't know how to describe, kind of a global phantom interest rate, a real interest rate that is, ballpark, it's about 2%. And that is sort of what the global kind of growth rate in real terms is. And every currency in the world is measured against that 2%. That becomes the replacement level for gold. It's almost like if I were to take a light and shine it in Plato's cave, and what you don't see, that's gold, in the way that gold is a currency. So whenever real rates fall below, this is at the short end, fall below about 2%, that's when gold rises. That's when gold does well, because it's trailing. It's not that gold is going up, it's the dollar is going down. And then conversely, when gold goes above 2% in real terms, that's when gold falls very, very sharply. Now, there's some interesting takeaways about this, and that is gold is not a buy and hold investment at all. It is one to own in very particular times. The other thing is that gold it's subject to political pressures. The Federal Reserve the Fed can kill gold tomorrow if it wants to by raising rates. That would just wipe gold out instantly. So when you're a gold investor, that's what you're tied to. But as long as gold, and it's been below 2%, basically almost for 10 straight years, and it rises. Very rough terms, for each percent that gold that real rates are below 2%. So if real rates are at 0, gold traditionally goes for about 8 times the distance you're from 2%. So if real rates are at 0, you're 2 points from it, then gold rate rises by an average rate of about 16%. And this is an average over many years, but it's held up surprisingly well. And that's what people who invest in gold is understanding is you're investing in the not dollar. That's what you're doing, as much as you're buying gold. But the key is it can rise very, very quickly if the times are right, and then when things turn against it, it falls very, very sharply. And if you look at the history of gold, it's a series of spikes and crashes, spikes and crashes.
Related to that thesis, how do you think about gold mining stocks? So companies that extract gold, trade as equities. I mean, do you have any interest in those, or is it just
don't follow that at all, because the businesses are so tied to the underlying commodity.
Yeah.
I'd rather get somebody Johnny Cash, do what you do well. So they make widgets, they do it well, and they sell lots of them.
Yep. As a buy and hold investor, and you were named by CNN Money the top buy and hold blogger on the web. Congratulations.
Thank you.
How has your thinking about investing in stocks in the market changed since the financial crisis?
That's a good question. I think the thing I really learned from the financial crisis, and I guess it's an old lesson, but you really were taught in a serious way, is the way the dominoes are lined up. And one domino that you don't think is next to another, you suddenly find out is. And one day AIG, in my opinion, was a well-run insurance company. They had a hedge fund on top of it that was causing problems.
Yeah.
That's not quite how we viewed it. There were a bunch of towns in Norway that got hooked up in some hedge funds, and they went bankrupt. These towns in Norway went bankrupt because they had mortgage securities in the United States. So some guy who bought too much for his home in one of the sand states in Florida or Nevada, and that brings a town thousands of miles away, and it bankrupts the town. And that's what we learned in the financial crisis, that all of these things you don't think are connected, or you don't appreciate, that they're much closer than you realize.
Do you think that lesson was learned by the larger investing population, and do you think that lesson will be remembered?
No, I don't think that message. I think there's I think the market has taken some bad lessons from the financial crisis, and one is I see sort of a lot of cynicism or cynicism masquerading as wisdom. And what you see a lot of when you follow the news, you see a lot of economic commentary, which is really it's morality, public moralizing masquerading as economic commentary. And then you see the incredible fear in the markets between stocks and bonds. I think it provides an opportunity, but I think there's the big lessons haven't been learned, and I think some of the wrong lessons are being taken in.
Let's expand that same question. How has your investment thinking changed over the course of your career, following stocks, writing about stocks, recommending them?
A few things that I've learned. One is it's just a truism. Is the trend can always go further than you expect, further than you thought. I think the stock, it's down to $9. It can't get any lower, and then it's at $6. And conversely, it can go at the other. It can't go any higher, and then it doubles. Yeah. And so that's something I've always learned, that end point is never where you think it's going to be. And then I think the lesson of humility is I've learned more and more of what I don't know, and I've learned to concentrate on the shrinking spheres that I do know, that I feel comfortable. And I think when I started out investing, I wanted to know everything. I wanted to know how all these companies work. And people will ask me about Groupon or these companies. I haven't the faintest idea what they do or how to value them. And I'm fine with that. But I used to want to be. I had to know this, and I'm fine. Looking to companies that I know about.
So you mentioned the trend, not knowing when it's going to either bottom out or when it's reached its full fair value. How do you decide? What's your process for determining when to sell a stock? Could you just take us through that?
Yeah, well, usually I'm crying, I'm curled up in the fetal position, and then I try to be very disciplined on how to, and you think about investing as business decisions. That's the best way to go about it. And whenever I decide to sell, I always try to pair it with either another buy. Sometimes I will set a specific date. I'm going to do it at this point, or if I'm going to replace it with a buy or partially and go into cash. So I try to be very mechanistic about how I and because,
is that something that you learned over time?
Yeah,
because you had
because then you pull the trigger, you get nervous, you feel like you have to do it, you feel like the price is going to get away from you, and if you just sort of learn to discipline yourself, part of it is just mastery and control over your own emotions. I always said if for Mr. Spock, if things didn't work out at the Space Academy, it would have been a great investor because you just you don't have those emotions and you push those away. So, and then as far as looking at a stock to buy, I basically look at the fundamentals, and if I see something is deteriorating, I don't like the earnings reports, I don't like some of the decisions they've been making, that's when I'll pull the trigger. Or sometimes I think I've just made a good profit and it probably has run its course.
And do you pay attention to management at all? How closely do you follow management? Is that a decision for you to either buy or sell?
Management is absolutely crucial. It's one of the most important things. I'm not a big fan. A lot of individual investors get into stock screens, and I think I urge people to sort of, I don't want to say ignore those, but sort of downplay those, because it doesn't tell you everything you need to know. One of the best ways to look at management is when you sort of dig down in the financials. Some things really can't be made up or fudged. Look at a company with high return on equity, a company that's consistently outperforming on its financials. Again, you can't always be in the building every single day. You don't know all the decisions, but that gives you a good idea. I like to see a management team that's been in place for a while. I like to see financials and management discussion that's very open and things that I can follow. I like to see consistent operating histories, a nice string of dividend increases. I'll give you an example. One of companies I like a lot is Aflac, the duck stock. And
we had Dan Amos in the office last year.
Yeah, and he's sort of a down-home Georgian, and it's a family company. And he's one of these guys, he sort of comes across as good old boy. These guys know exactly what they're doing. Yeah. And I remember when there was the terrible earthquake and tsunami in Japan, and so much of their business is based there, and so they were on television asking him about this, and he said, no, we're ready. This is what we do. We're prepared for this, and we're going to be fine. And that means so much when you see these are professionals. They know exactly what they're doing. And a lot of times people assume that these companies are they're just going to move in the 1 point trend is going to continue. And so a lot of people were concerned about Aflac and their investments in Europe, and that got a lot of concern on Wall Street. And what did Aflac? Well, they headed it off. They did something about it. They were ahead of the curve. Now they think some of a bite on their investments in Europe, but these guys are smart and they're looking out for that. So that's why that's what a good management can do, because people assume that it's just this one company is sort of it's a one variable operation. It's not at all. They're constantly or here's something you'll see. XYZ Corp has come out with a press release, and we announce a cost-cutting initiative. And well, that'll get a little pop in the stock. Now, the obvious question is, what were you doing beforehand? Was that the profligate, initiative? Good companies are always looking for ways. They never announce it because they're always doing it.
Yep.
And so you can always, after a while, the quality does shine through. Management is key to every business.
When you get questions from new investors, what's your advice to them?
Well, it sort of depends how you want to invest. I think that there's nothing wrong with passive investing, and for a lot of investors, that's great. If you put half your money in a stock ETF and half your money in you go 50% in SPY, 50% in TLT. You're gonna beat a lot of people who are paid a lot of money, and that's fine. There's nothing wrong with that at all. Now, for investors who enjoy it and like to be part of the investing game, which I am, not everybody is, but so people who are who are interested in that, then my advice is look for companies that aren't followed by everybody else. Go off the beaten path. Everybody's got an opinion about Google. And everybody's got an opinion about Exxon or all these companies. There's 40 analysts who follows it. There are hundreds of companies that aren't followed by a single analyst. These are orphan stocks.
Yep.
And it's not worth it to Wall Street. I'll give you an example, and let me preface, I'm not recommending this, but a small company called Nicholas Financial, which I write about a lot. It's not covered by any analysts. And I made a few calls, talked to the people there. You call them, you say, I'd like to ask them questions. Some companies, sure, they'll be happy to talk to you. Nobody calls you your job and asks you about it. You can read the financials, and it doesn't take long. You know as much as anybody. And this company really impressed me by what they did. And I felt like I was a kid in a candy store. Nobody knew about this company. They make used car loans for used cars. And with that, you can charge about 25% in certain states. So they have, I'll give you some rough numbers, about $270 million in used car loans. They get about 25% on that, so that's $68 million coming in the door each year. They're about $100 million in debt, and that's at 5%. So think about that spread they're getting. So it's 68 million coming into the door, 5 million going out. So you're netting 63 million. The total operations to run the business is about 27 million. So that brings you down to about 36 million. And then taxes, which is a big hit, that's about another 14 million. So last year they cleared about $22 million, and they have 12 million shares outstanding. It's a tiny company. I mean, Citigroup is 1,000 times larger than them. But they made $1.85 a share. At their March 09 low, they were at $1.85, right about that. So they were trading 1 times earnings, not 1 year out, not 2 years out, but between 24 and 36 months out. They were trading at 1 times earnings, and nobody knew that. And I think they were dumped in. People thought they were a subprime lender, and they at no point were they losing money. At no point they turned a profit every single quarter, and people were treating it. I mean, they really were going at pennies on the dollar, and the stock was at $1.85, and now it's at $12.50 today, and I still think it's a bargain. I think it should be at least $17, $18.
It's the one up on Wall Street, Peter Lynch. I think his example is Pep Boys, and it had a silly name. Nobody followed it.
It's too goofy to even follow. Who thinks that it could be that profitable?
He made a mint off of that. What is your view of the advisory industry? And obviously we're do-it-yourselfers. You're a do-it-yourselfer. Do people ask you about whether they should go with a professional, and if so, what do you tell them if they do ask you?
Can I skip that question?
That's fine. All right, let's drill down on some specific stocks. So, Facebook is all over the news, all over the media, and really, it's with hundreds of millions of users. Everybody's familiar with the product and has been asking about the stock. It was at $26 as of the close last night. I'm not sure what it's trading for right now, but do you like Facebook as a stock? Do you hate Facebook as a stock? What's your view
I do
on it?
not like Facebook as a stock. First, what investors need to understand something about IPOs, and IPOs are rather dangerous area, because that is one of the times where existing shareholders and new shareholders about to come on board, are in direct opposition, and it's not pleasant, and this is what can happen. And basically there's an implicit message from any company going public that they're saying our stock is overpriced. Not by some amount. That's why they're selling shares. And in the aggregate, IPOs have not been good performers in their first few months. But the company has, they're out to make a profit, so I don't fault them. I think Facebook in this case was very ill-served by their bankers, and I think they pushed for too much than the market could bear, and now there's a backlash. Now I know Facebook is overpriced. I thought it would take a lot longer to fall. I would say, Facebook reasonably should be in the mid-teens right now. So it still has a long way to go, in my opinion. I mean, when I'm looking, I'm extremely discriminatory as far as investing. I look for very, very good bargains. I never take a risk I don't have to. That's one of the keys to investing. So Facebook gets a lot of attention. If something gets a lot of attention, almost by definition, I'm not going to be interested in it.
That segues nicely to Apple, which...
Never heard of it.
Brian, might be the only company.
That name means nothing to me.
It's
I've never... I would say it's the Beatles company, so I don't know what Ringo's up to. Actually, I like Apple. I mean, Apple is almost words fail you. It's a titanically profitable company. They have a huge amount of cash. Just their bank account is, I think, $120 billion.
Yeah.
I mean, that's larger than most
whole
banks.
Countries. Yeah.
And that's just their bank account. Yeah. Apple can buy every single team in the NFL, every single team in the NHL, every single team in the NBA, and every single team in Major League Baseball. They can buy every single team, and they still have cash left over. It doesn't make a dent at all. They don't have to borrow at all. So let's just look at this. Let's just break down the math to see what Apple's like. Right now it's about, say, $570 a share in that ballpark.
Yep.
The cash is, I think, about $115. So we're back of the envelope. Let's just knock that out. It's not exactly how we can do this, but let's just do it for the sakes right now. So that brings us down to around $450. The company is going to make about $45 a share this year. We know that pretty well. This isn't following some 5-year, line that who knows what has come up with. We're pretty sure that's what they're going to do. So that means they're going for about 10 times. There's based on just the operations of the company, it's yielding about 10%. And the company just always has blown away earnings, they purposely play a game. But I mean, it's such a remarkably profitable enterprise, and they generate cash to such. I mean, I can't think of anyone outside of the mafia. I can't think of any organization where the profit margins just flow in like that. So, but I like Apple. I do like Apple.
So, on your list of 2012 stocks on your website, Crossing Wall Street, let me just ask you about a few of those stocks. So, one of them is JPMorgan. And
do you have to ask me about this?
So JPMorgan has also been in the news lately for the wrong reasons.
Yes, it has.
Has your view of JPMorgan changed at all in the last 4 weeks?
Okay, well, this is one of these. It's a good lesson for investors because, it's one of these companies you love to hate, you hate to love. We have to say it's a very good company. They never lost any money during the financial crisis. They always stayed above water, and they're making a good profit. They had this recent scandal, which cost them money. In the large scheme of things, it's not a huge amount of money, but this is what investors pay attention to. They're being punished far more than the damage really was. Yeah. So to be a good investor takes notice over those sorts of things. But that's the key about picking up a good company is you're almost always going to get something that's, it's a new toy that's damaged and dinged up in some way. And you have to ask, is this damage, is it transitory, or is it something that's deeply embedded in the company? With JPMorgan, I think it's pretty clear that these are transitory issues, and just just looking at the dividend alone, which they just increased. I mean, you're getting a good return, and they can pay a lot more. I think one of the problems they're having now is Mr. Diamond, who he's a loudmouth. He's a highly competent loudmouth, but he is a loudmouth, and I think, from my point of view, I think it would be time. I think the best interest of the company would be served if he were to move on, or if he could stay on as chairman of the board. But I think it's too much of a drag on the stock. But it could be $40, $45 stock, no problem.
Ford is another one on your recommended list, and we talked a little bit about management earlier and how important management is. Alan Mulally is seen as irreplaceable, but the buzz machine is starting about whether it might be time for him to move on as well. Do you see Ford persevering after Mulally?
I do. I'm a big fan of Ford. I think they have done an amazing job, and I think the stock is. I'm astounded at how much of a bargain it is. Literally, I think it's $10. I think it can be $20. And a lot of it, we have to give Mulally credit. Now, there's sort of two different skill sets of engineering the turnaround and then leading the company forward. Have they reached that point yet? And are the problems become so severe that that's worthy of a change? I don't see that just yet, but that could be brewing. What Ford has done a remarkable job of lowering their cost per automobile, and that was really, really tearing into them. And they worked to bring that number down significantly. So each unit they sell, they're making far more money, and then they're working. They're going to even do that further of paying down debt, and then they have plans to take some retirees off the books and buy out some employees early. I think all the arrows are heading in Ford's direction, and they just had another good sales report. It's I really think it's one of the turnarounds. I called it my stock of the decade shortly after the new decade. So I wanted to get ahead of everybody else. So that's just And
you're standing by that flag in the ground.
I am standing by. I think in 2011, I was ready to call the trend.
Of the stocks on your buy list, and you have 15 or so stocks on the list.
20 is what.
20 stocks. Do you have one? And maybe the answer is Ford. Do you have a high conviction stock that you think is, you kind of favor more than the others, or maybe there are 2 or 3?
Well, what I do is I've 20 stocks on my buy list. So let me explain. What I do is each year I come out with a list and of the 20 stocks, and they're locked and loaded for the year. I can't make any changes. Okay. And just to make sure, and people say, I come out with a list around mid-December, just so people say I don't, game it somehow. And then the last few years, I only changed 5. I changed just 1/4 of the list, and we've beaten the market for the last 5 years in a row. And I'm trying to show investors it's one of these things, by doing less, you can do more. I don't have specific things that I say are my favorite stocks. I consider them all equally weighted at the beginning of the year. Now I have my in my weekly newsletter, CBS Market Review, CWS Market Review, which you can get at my website. You can sign up for free. In each issue, I try to highlight things that I think are good buys right at the moment, that I think are exceptionally good buys. So that changes from time to time. But a lot of times, the regular names, certainly like Ford, certainly like Aflac. Those are the list right now. I think Oracle is looking good right now. They're coming out with a earnings report in, I think, 2 weeks. Their guidance wasn't great. It'll be interesting to see what happens, but I think it's going for a good price.
Let's drill down on Oracle for a second. So it's costly to license the Oracle products, so it's got a good foothold among Fortune 500 companies, but some smaller and mid-sized companies might go to the cloud instead because it's just cheaper. How do you see Oracle navigating that potential disruptive shift with the cloud?
Yeah, I have to skip this. I just don't know it.
No problem. Let me ask one more question about the size of the portfolio. So you have 20 stocks on the buy list. That would put you at a fairly, well, let me start over. So you have 20 stocks on the buy list. How many stocks would you advise a do-it-yourself retail investor to potentially own? Is 20 enough for broad diversification, or how do you advise people on that?
20 is a very, very large portfolio. Actually, you can be well diversified in as little as 8 stocks. You can be very well diversified in 8 stocks. Now, the key is being diversified. A lot of people feel, I am diversified. I own Google and Apple and Oracle, and you want to have different categories. You want to make sure there are cyclicals, non-cyclicals, income stocks, tech stocks, healthcare, always a good sector, and that's the way you could have a nice balanced portfolio. So you can be very well diverse with just 8 stocks. I think the advent of online brokers and the lower commissions is great for individual investors and do-it-yourselfers who can get out and do that. And as you build up your portfolio, I think if you're dedicated to following the name, I have 20 names. Your goal should be you can have as large a portfolio as you can be. I don't think there's any limits in that.
How do you think about international investing? A company like Johnson & Johnson derives a great deal, or Coca-Cola earns more than half its profits overseas anyway. So it's kind of an international investment just by virtue of its revenue breakdown. Is that sufficient for a U.S.-based investor, or do you think that people should actually look at companies based overseas or indexes that
it actually is? I mean, you are buying by buying U.S. domiciled companies, you really are getting a huge amount nowadays. You're getting a huge amount of global footprint going along with the companies. So I don't think it's a necessary need to sort of go out. I mean, you think of something. Take a company like Nokia. Well, what company is Nokia? That's Finnish, right?
Yep.
So when the board of directors, once a quarter, they all fly into Helsinki and they all get together, do you think they're speaking Finnish at the meetings? I don't think so. They're speaking. There are these companies that are sort of, they almost don't have a domicile.
Yeah.
And so just by on New York Stock Exchange listed companies, you can get plenty of coverage in regular U.S. companies.
Yeah.
I'm not saying you should. You can do that and go overseas and look for bargains. Any place there are bargains, any place that's not well covered, I think is a good place to look for opportunities.
Yep. Eddy, I'm out of questions. I really appreciate your time, and hopefully we can do this again soon.
Great, my pleasure.